Summer's almost over. The kids in many counties of California are not going back to school, but they're going on to school online. So summer's almost over, and this is a mortgage market update about what's been happening, where are we at, oh my goodness, what's going on. Okay, so if you've been watching my updates, you know it's been pretty volatile recently. So we had COVID hit, and we saw the whole market in terms of options go like this. And over the last few months, we've seen it open up a bit. So like for instance, with VA, we're now doing credit scores 600 and above, yay. But not all lenders are doing that. Some lenders are still restricting it to 640 or 660. So if you're a VA buyer, you definitely want to make sure if someone tells you, wait, no, you have to have this credit score, that you do check around, because different lenders are doing different things based on how much risk or how much fear they see in the market. So that's important. Conventional mortgages, I thought we were going to see a lot of changes too. And it's really interesting because I haven't seen any big guideline changes. However, I have noticed that, for instance, if I'm running a person's file through what's called desktop underwriting, that Fannie Mae definitely has gotten more sensitive. So loans where I look at it and I go, oh yeah, this totally meets guidelines, debt to income, credit score, everything, it meets guides, we're not getting approve eligible sometimes. So if you guys were pre-approved a couple months ago, you definitely want to touch base with your lender and just say, hey, you know, I was pre-approved. If you didn't run desktop underwriting then, please run it now, just to make sure. Because, you know, sometimes with Freddie Mac, because there's two, there's Fannie Mae and there's Freddie Mac for conventional loans, and we run it through desktop underwriting for each one. So I've seen Fannie tighten up a lot, it feels like to me, and that's because the ones where I'm like, wait, why is this getting a refer? It's because it's seeing more risk. It's reading more risk into the market. Whereas Freddie Mac, I'm not seeing the same thing. But just assuming right now that if loans meet guidelines, you're going to get an approved eligible through the system is a terrible assumption to make. You know, I'm getting calls from realtors where they're like, oh, we're 2 weeks from closing and the lender just told me that they don't qualify. And it's because the lenders are not running these files through desktop underwriting up front. So if you guys are working with a lender, and I wouldn't feel bad about asking, hey, did you run this through desktop underwriting? Just cover your bases, because you really want that approve eligible. That approve eligible is a golden star, okay? So very important to note. Jumbo. Oh, Jumbo. I miss you, Jumbo. I miss you so much. So there still are some investors doing jumbo. We're still doing jumbo. It's not dead, okay? But it is definitely not for the faint of heart. And if you're on the edge or you have cuspy qualifications to start, now is not the time to buy the house. It's really not. The jumbo lenders that I'm seeing, they are looking for those A+ golden borrowers, perfect situations, no hair on the file at all. So if you're self-employed and write off all your income, I haven't seen any bank statement programs come back. Look, there's always brokers that watch my videos. If you guys have any of those loans, chime in right now. Like, put in the comments that you have them, because people want to know about them. I am not seeing them, okay? The one thing that's really brutal, there's a couple brutal things about getting a loan during COVID. And overall, 30-day closes are still fine. Where we hit bumps is when we're trying to verify employment at the end of the transaction, or when we're trying to get a pay stub right before closing, because you've got two things going on. You've got the people who you're verifying the employment with going, we already did this, why are we doing this again? And then you have the borrower who's already provided pay stubs, saying, wait, I already gave you a pay stub, why do I need to do it again? It's because of COVID, guys. We got to make sure you're still employed. And look, it's annoying for us as well. We don't like asking for more documents. We would love to close the loan and be done. The verbal verifications of employment at the end are horrible. I have one person on my team, their entire job is doing this because they are so difficult to get. So any help you can give your lender, go for it. If your lender's asking you for stuff, guys, just give it to them. None of us are asking for stuff right now because we want to torture you. The one segment that is truly the most brutal is self-employed. Yeah, self-employed, conventional. Oh my goodness. And the reason is that we're looking at tax returns, of course, like we always would. This is for a conventional, Fannie Mae or Freddie Mac loan. But at the same point, we're also asking for a year-to-date profit and loss. And what I'm seeing is, I can ask a borrower 6 times, hey, has your business suffered any losses from COVID? No. Are you sure? Yes. Is everything going to match the income that I have here based on your tax returns when I get your profit and loss? Yes. And then I get the profit and loss and I'm like, dude, you're like 40K in the hole. How does this work? And they're like, oh, my bookkeeper did it. I didn't know. Guys, if you're self-employed and you're buying a house in 2020, you're gonna need a profit and loss. I don't know lenders that are skipping that right now. So for this year, if your income is declining for this year, we are gonna go with the decline. And it's unfortunate and it sucks, but the problem is that COVID's here, it's real, and it's affecting businesses in a very negative manner for the most part. And lenders have to be able to show your ability to repay. So looking at 2019 and saying, oh, they made $200,000 in 2019, no problem. No, they're gonna look at 2020. And if they see that you made $40,000 in 2020 year to date, and it's not up to with what you've been doing, it will and can affect your ability to qualify. So it's really important that if you guys are watching these videos going, well, I'm self-employed, I want to buy a house, like I got my taxes done, I finally did my taxes, you're going to need a profit and loss, okay? And look, you don't have to have it be accounted for a lot of the lenders. Some of them you just have to put it together yourself. Of course, it needs to be accurate, honest, and truthful. And then we verify it with 3 months of your transactions. So if you say your business makes 20K, but we look at the bank statements and we're like, there hasn't been a nickel deposited, that's not gonna work either. So that's the area that I see that's really, from my perspective as an originator, it's really painful because there is nothing worse than telling a client, hey, we can't do this because of this. And in a lot of cases, people are just trying to get a lower rate, and it's really upsetting, but we don't have any power here. We have to follow the rules, and these are the rules right now. So be aware. Rates. Every time I think they can't fall anymore, they fall. So I've given up trying to play like the crystal ball of how low will they go, because there's 2 really strong ways to argue this. You could argue this as like, because I have these arguments with my husband, my coworkers, multiple people in the industry. Like, we're all trying to figure out what's going to happen next so that we can prepare for it, staff accordingly for it. We're all hiring like crazy right now because of the volume, because we want to try to keep those service standards up, but we don't know what's going to happen next. So argument 1, rates are going to go up next year. There is an argument for that. And the argument on that is that basically the risk of doing mortgages coupled with inflation will make it impossible for rates not to go up. Okay. And then there's the other argument of they're going to have to keep rates low. They're going to go even lower because they're going to need to do that to stimulate the economy. So you've got 2 really strong viewpoints there. Both of them make great sense. We just don't know what's going to happen next. And what I see as an originator in the market, and look, I am not an economic guru. I'm sure that there's some economic professional that's going to be like, well, wait, if you take in factor, and they're going to give us an analysis that none of us are going to understand. But those are the 2 arguments boiled down into English, okay? And I don't know, I guess I'm being defensive today. But I'm just ready for it. I'm ready for it. So lots to consider, okay? As an originator, when I'm looking at rates right now, I'm like, if you like it, lock it. Because going, well, if it's at 2.875 on a conventional 30-year fixed loan, and you're like, oh, it might go to 2.75. It might, but it might not. And you might lose 2.875. So I don't know about you, but if I could lock my house at that, I would be locking it all day long, because we're talking about historic lows. And holding out for 1/8%, it depends on where you are. If you're at 3.25, fine. If you're at 4% and you're holding out from 2.8 to 2.7, I don't know. And look, these are just random rates that I'm throwing out there. This is not a guarantee to lend. I'm not promising you any rates. I'm just saying, if you're looking at rates that are 1/8% and you're 1% higher right now, like, If you like it, lock it and don't mess around with it. Okay, so I hope this video has been super helpful. I know it's a little bit rambly, but that is our mortgage update of the week. Thanks for watching.